It's tax season, and if that makes you clench every muscle in your lower body, we've got the show for you. We're going to give you 7 tax strategies that were learned the hard way by a very experienced gym owner. His name is John Franklin. I'm Mike Warkentin. This is Run a Profitable Gym. Please hit subscribe before we go any further. John, tax strategies. What's your worst story? Do you have any horror stories from back in the day? I have a couple. What was the worst thing that happened to you?
Let me start by saying I get all the fun podcasts.
Yeah,
It's
you
like
do.
Chris Cooper gets to do the annual planning, and then he throws me in the ring to, oh yeah, talk to him about taxes. They're gonna love that stuff.
And you have to battle the IRS.
Luckily, I've never had to go through like a full-on audit. I think the worst, or which we'll talk about, is just being wholly unprepared for what my tax liability would be. In Canada, I know they look over you with a microscope, so I'm sure you've gotten a lot more scrutiny than I have. What's the worst you got, Mike?
We had a pretty on it bookkeeper, so we didn't get a lot of surprises. But one of the things that I didn't know about when we first started the gym was we would buy stuff from an equipment manufacturer and they didn't charge tax. And this was great. We thought we were getting a break. Turns out you're supposed to actually report that tax, self-report. So you're supposed to turn yourself in and pay the money. I never did that. And then I realized that I had to, and I did and cleaned all that stuff up. And that was a cost that I didn't see coming. So, and my accountant didn't see it either because she didn't even know that we were buying equipment from a vendor who wasn't charging Canadian tax. So that's a common one, but there are also way worse ones where it's like, I haven't done this one, but I know people who have done this one. I took tax off. I withheld tax from my employees' payroll. Then I spent it and now it's due. There's a good one. All right.
I think the worst I ever had is my wife had a nutrition business that she sold, and the person who bought the business didn't change the EIN number in the Stripe account. And so like 3 years after she sold the business, she got a letter from California, the state of California, because that's where the new person who purchased it was located out of, asking for a shit ton of state tax. And then she had to go and unwind that, and that took a solid 8 months of time and probably more than 8 months of stress and headache.
And isn't the tax rate in California like 98% or something?
That's exactly what it is, 98%, which is
similar
why,
to Canada. We're similar.
That's why I moved to Florida, so it makes make this a little easier.
Yeah. And then there's also those things where you have corporate tax. So you look at your books and maybe you're a new gym owner, you're making money. You're like, this is fantastic. And you see that there's profit every month and you start spending things, or you start assuming that you're not going to have to pay anything out at the end of the year. Then you get a tax bill based on your profit. And you're like, oh, maybe I made some bad decisions there with that money that was actually owed to the government. So there's stuff like this that crops up. John and I are not accountants, but we have gone through this stuff for a pair of decades, probably, or a little bit more as gym owners. We're going to give you some advice. And this comes from John's experience mainly in the US. I'm going to give you a little bit of Canadian perspective here. And if you're in Europe or some of the other places like Australia, New Zealand, check your local stuff. The best advice is always to check with a qualified professional who can go through your books and help you figure out exactly how much money you owe the government, not a penny more. John Briggs is a guy we often use. He's written Profits for Micro Gyms. There's a resource for you there. So John, let's go to number 1 on your list. What is something you learned, a tax strategy you learned as a gym owner?
So it's the most obvious one, but it's the one nobody listens to, which is tax time is not the time to start updating your books.
Go to the shoebox and dump, right?
I mean, typically the way it goes is you hire a bookkeeper. They may or may not be on top of things. They're using QuickBooks, and QuickBooks at this point is like all run off of like rules. It's pretty automated. And so you're assuming the bookkeeper is doing their job, and you go at the end of the year and your books look like absolute chaos. Nothing makes sense. There's a lot of stuff misclassified. And I'm not here to beat up on bookkeepers. The reality is they can't like read your mind. So whatever a $70 charge is for, HY7, which is how some things may be classified on a credit card, they're not expected to know that. And the other thing is, like, if you use a service, a lot of these services will outsource to, India, Philippines, places where labor is cheap. One of my examples while running a gym is I had a bookkeeping service doing my books, and I could tell it was outsourced because they were misclassifying their own service. So the bookkeeping service was like classifying their stuff as marketing when obviously it was. Yeah, exactly. And so at least once a month, you want to go in there and make sure that where things are classified are actually appropriate. And one of the things that is kind of like a step before that, is making sure you have the appropriate classification. So if you search through TwoBrain, we have a couple sample P&Ls so you can see how you like to set, so you can see how we like to set it up. Because the reality is at TwoBrain, we preach something called the 4/9 model, which means you should pay your staff 4/9 of the revenue you make, 2/9 should go to your expenses, and 3/9 should go to you as profit. And so if you're using that as kind of like your North Star for where money should go, having misclassified expenses throws the balance off. And the other thing is you're not really sure if you're overpaying your staff, you're not sure what your actual marketing cost is, and you're not really sure if you're hitting your actual profit targets. And the only way to do that is to really be sure that your books are clean, up to date. And the only way to do that is to go through with a fine-tooth comb and ensure that everything is clean. Because the reality is, I have trouble remembering what I had for breakfast yesterday, much less what some random contractor payment or credit card charge or Upwork thing was over a year ago. So the best time to do it is, yesterday, and be on top of it as much as you can, because the cleaner it is, the better business decisions you can make.
So John, you mentioned a spreadsheet. This is a P&L I've got on the screen here that Chris Cooper created specifically for a gym business. And if you look, recurring expenses, a whole bunch of hidden lines here, but it's all sorts of things in there like meals and rent and insurance and all sorts of different stuff. This thing is available. If you want it, you can go to Gym Owners United and you can DM Coop. Just ask him, I want your P&L. He will send it to you. And this thing was made specifically for a gym. In that thing, you're going to classify your expenses properly. And again, in a small business, you don't probably need 700 lines, right? Like this thing, Coops is about, I think it's about 70. And there is some very specific gym stuff here where you've got like paying clients, average ramp up costs, some staffing and class things and things like that. Your bookkeeper, a general bookkeeper, will not have something like this. It's not as specific for a gym business. So if you want this, it is available. Go to gymownersunited.com, DM Coop for the P&L, and you can do that. John, for a P&L, when you were running a gym, was yours a big, massive, intricate document, or did it kind of look like this, where it was in that like 70 lines kind of thing?
I tried to keep it simpler.
Yeah.
And trying to get your basic, your gross profit and have staff expense classified properly and try and categorize the revenue. Mm-hmm. I thought our books were awesome, right? When I was running gyms, I thought we were doing a pretty decent job. But then I went to this event with Chris, and it was an event of people with businesses like TwoBrain, where they coach people in the brick and mortar space. And like one of the exercises is they would take the P&Ls of these businesses and just like slap them on a projector. Then everyone in the room would roast them. And when I saw that, I realized how bad of a job I was doing at understanding what was going on in my business. And that's why, like, even if you're someone who thinks like, hey, I got this under control, I'm ripping it. It is nice to get the eyes of a mentor on it. It is nice to get someone, like a financial professional who is used to working with people in the fitness space, because you don't know what you don't know, right? And it wasn't until I saw what good books looks like to make me realize like mine were not as good as I thought they were.
Mm-hmm. So if you have no P&L, get one, and you can start with Coops, and you can also talk to a bookkeeper, accountant. If you do have a P&L, review it and start seeing what can you do better on this thing, and don't wait till tax time. And again, it depends. We're coming up on year end here for 2024, and I know some corporations have year ends that are in June or July or other months or whatever. Don't wait until the very last minute. As John said, that's his number one tip. Don't wait. Start getting things untangled now, because it's way, way worse then. And then all of a sudden you might have some weird bills that you've got to figure out. So don't wait. Number 2 on your list, John, this is a really good one. I like this. Which is it?
Get a tax estimate. And so
that's the surprises.
This is a controversial thing. I don't pay my estimated quarterly payments. In America, you're supposed to pay every quarter based off of your income the year before. And I just take the hit. I take the penalties. I want to feel the pain once. I don't want to feel the pain every 3 months. So I don't recommend necessarily doing that. But the downside of something like that is that if I don't know what I'm paying in tax, April comes and I have to write this massive check. And if I don't have the money in the account because I blew it all on speculating in crypto or GameStop stock or whatever, I bought my competitor out. Yeah. I'm cooked. Like the
Yeah.
IRS still needs that money. You have to pay it. Even if you're having a bad, like if 2025 is bad, you're still on the hook if 2024 was very good.
Mhm.
And so one of the things that you can do to just get an understanding of where you're going to be is just go to your CPA and get a tax estimate. Usually they can bake something up for, $300 to $500, and they give you a general idea of what you're going to have to pay. And if you do that at the end of the year, April is tax time. That gives you 4 months to figure it out how you're
Mhm.
going to get that money. And if you, file for an extension, you're still going to pay penalties until the point you pay it. But that may give you a little more time to get everything together. But if you don't know, you can't get prepared.
Yeah. And I'm the opposite of you, where I like to over contribute taxes so that I don't get a giant bill at the end. I'd rather do the thing where I just like make sure that I'm not going to owe a bunch at the end. And I do the same thing. I ask my accountant, am I on track here? She says yes. And then at the end of the year, the government might owe me $100 or I might owe them $100 or vice versa. But we get really close to it, and that avoids surprises. And that just works for my style. So whatever style you use, figure out like, am I on track? Because the worst thing you can do, and I know people that have had this, we've seen them sometimes pop up. I just got an $80,000 bill. And like, where does that money come from at that point?
No, yeah, that's where you don't want to be. And if you're someone who's having, if you're losing money, whatever, you don't need a tax estimate. If your gyms suck and win,
We're cool.
But if you're if you're cooking, like you should figure out what you owe, and especially if you're someone who's playing pretty aggressively, wants to expand, open other locations. Like the money can go out and the tides can turn pretty quick in this industry, as anyone who's operating during COVID can tell you.
Yep. Plan ahead. And that's just a little bit of financial literacy. You're using your resources, using your professionals, you're using your spreadsheets, and you're figuring out long-term planning. And we've talked about annual planning on the show a lot. This should be part of your annual plan. Tax planning at the tinker level, where we're talking upper level gym owners, we're talking to like legacy planning. So we're talking about like tax strategies over generations and things like that. So that's how far this thing can go into the future. But start with a 12-month plan, figure out what you're going to owe and have that money available. Number 3 on your list, I love this one. Talk about it.
Yeah, it's just don't waste $1 to save 35 cents.
This is a good one.
There are a lot of accountants out there. Like, you want an aggressive accountant, you want somebody who, doesn't like taxes. You don't want to hire yourself a bean counter. You want someone who's going to, implement some of these strategies for you and try and get you to pay the lowest tax bill possible. But some of these people who skew a little more aggressive, they may say like, hey, you got, an extra $20,000 in profit this year. Go out and spend that so you can save on taxes. And so you go out and buy some garbage you don't need. But the reality is, like, that's $1 out, and you saved 35 cents, but you spent $1, right?
Now you have 20 sandbags in the corner of your gym that no one uses.
Right. Or some truck you didn't need or whatever, I would prefer personally to just pay the tax bill, invest that. And, if your goal is to build a resilient business, a business that generates wealth for your family, you're not going to avoid taxes completely. It isn't realistic. So, at some point, the cash flow is so strong that, you got to pay the tax bill. And sure, I can hear all the real estate people screaming and saying, but real estate. Fine, but like, you're still going to pay taxes on that unless you 1039 exchange over and over and over again. But for most gym owners, I think in our state of the industry, it's under 10% own their building. So it's not like a real play. It's not a viable strategy for most people. So again, just be sensible. If you're someone who's around the average, which our data shows is, between 3,500 and 4,000 take home pay, don't blow 30,000 on something you don't need. Pay the tax bill and put the extra 20,000 in your pocket, or put it in an investment account, let that grow and take care of your family. Like, as gym owners, there aren't a lot of gyms that have been around for 20, 30 years. Like, look around your hood. How many have been around since 2004? I would guess pretty close to 0. And so I think as a community, we need to think more about planning for our future.
Yeah, and since the first lord of the realm showed up and whatever, they found a way to get tax out of legitimate businesses. So if you're running a legal business, you are going to pay some tax. You're going to have to do that. My analogy on this one, John, is we sometimes, my wife and I, after a workout on a Sunday, we'll get a coffee and a donut on the way home, and we order 2 donuts, 2 coffees, and the person says, if you order 6 donuts, you can save the tax due to some weird Canadian law where 6 donuts becomes a meal that's tax free or something like that. And I think about this like, you buy the $4, you have 4 more donuts at $4, whatever, and you save 20 cents in tax or whatever it is. That's the exact thing John's talking about here. You spent this money and you probably didn't need the donuts and you saved a little bit of tax. So like if you get this advice, take it with a bit, think about things you actually need. That might be the time to get something that you do need, but don't spend it on nonsense, and don't just like, I'm saving the tax, because you never really save the tax. What's next on the list?
Also, I said 1039. I meant to say a 1031 exchange. That's just like a thing that allows you to like roll your capital gains in real estate into something new if you're just keep buying within a certain time frame. So
yeah, and the government's still going to find you at some point somewhere on the chain, right?
Yeah. So for those real estate gurus cursing me over the air, I apologize. All right. And so the next one is pretty simple. Like most gym owners have kids. If they're old enough, you can put them to work and pay them to do legitimate tasks. And you can pay each child, again, this is in the US, somewhere around, I think it's 14,600 this year. So if you pay them under that threshold, they don't owe any federal tax. And that, let's say you have 2 kids, you pay them 14,500 a piece for work they did in the gym. That's $29,000 in taxable income that's shielded. So, that's about $7,000 in tax savings. And you can also put that into a custodial account for them, invest it, and start taking care of your kids' financial future. At 18, they would get control of the money, but they can use it to go to college. They can use it for a wedding. They can use it to buy a nice car. But again, this is something that is probably a better strategy if you are a higher earning gym owner, someone who's over that 100,000 in net owner benefit and is looking for ways to protect yourself. If you're, someone who's bringing home 3,500 a month, you don't have to stress out too much about this, and you probably don't want to push, 29,000 of your 40,000 income over to your children. But just one I want to put out there, and just a way that you can pass wealth down to your children in a tax efficient way.
And the big qualifier that you said there was the word legitimate. So if you have a newborn baby and she becomes your social media manager for $14,000 a year, is that legitimate?
You can use them for marketing. They can be in marketing. You can put them in ads. So, I'll be running some ads with my children in them before the end of the year. And so,
models,
again, it is gray what is legitimate and what is not. Again, talk to a tax professional that's outside. I rely on mine to tell me what is good and what is bad here. You should do the same.
Yeah. So if you have some, keep it in the right, you can have common sense on this, but then do run it past your professional who can tell you, yes, that is a legitimate defendable write-off, or no, that is not. And maybe we can find a different way to do it. So the difference that John laid out between having your, a young child as a model, that you might pay a model fee to someone else if you're running a kids campaign, that's legit. Having someone who's completely unable to run a social media account, running a social media account might raise an eyeball. Do ask your professionals. What's next?
Bonus depreciation, one of the wonders of the world.
Okay.
So again, let's say you do legitimately need to update your fleet of eco bikes or Concept 2 rowers, some very expensive piece of equipment, or you want to outfit your gym with some fancy saunas and cold plunges. That stuff, since they're assets, they'll go on your balance sheet and they get depreciated over, I don't know, a 7 to 10 year period. But in America, there's a law saying that you can take bonus depreciation up to 80% in the first year of purchase. So let's say you spend $20,000 on new Concept 2 rowers, you'll be able to write off 80% of that in the first year. So that's $16,000. against your taxable income. And the thing is, if you finance that, I believe you're still eligible. So if you buy $20,000 equipment, but you only required, a $2,000 down payment, and then you just made payments on the rest, the interest would be tax deductible, and you'd be able to take that whole piece of the bonus depreciation in the first year. So, I know over the air, this is hard to see, but, $2,000 down as like the down payment for $20,000 of equipment, and you're getting $16,000, a $16,000 offset of your taxable income. So, again, talk to somebody who can advise you specifically, but it is an effective way to kind of hide some of your income in a better year.
Yeah, so that might be exactly what you said there. I think is the key qualifier is in a better year. So if you're having a good year, you could use this and knock off a whole bunch. If you're, say, having a year where you don't need that, you maybe wouldn't take the bonus depreciation, correct?
Yeah, and if you don't if your gym's running just fine with 15 rowers, you don't need to buy another 15. Like, that's the important thing here.
Yeah.
Like,
Yeah.
only buy what you need. Don't have 15 rowers collecting dust to save 16,000 off your income.
Yeah, this would be a strategy if you're doing this thing anyway. It would not be do this thing to use this strategy. That would be a mistake.
I think so, but different strokes for different folks.
Oh, there you go. All right, on the list, go further. What do we got? Which number is this? Are we at 6?
Yeah, and this one's another obvious one. We spoke about how there aren't a lot of 20-year gyms around. You should have a retirement account, and you should be striving to max it out, right? Which one you choose is going to depend whether you have staff or not. So a solo 401k or a SEP IRA allows you to throw the most money into them, but they aren't the best choice in most cases if you have W-2 staff, because you have to offer some of the same benefits to them, which could become very expensive. But there are, traditional 401k, simple IRA plans that will allow you to operate in a tax efficient manner. It could be a potential benefit for some of your full-time employees. So which one will depend on that, but the tax savings there are pretty straightforward, where, you put money into those accounts, and in most cases, that offsets your income for that year. Downside is you can't touch that money until you're in your 60s. But again, like, we gotta take care of ourselves, You don't want to be the Walmart greeter. You don't want to be out on the floor training people one-on-one when you're 80 years old. That's going to be, you're going to be tired.
Up here in Canada, we've got things like RSP, which is a kind of version of that where you can shield some income. You get taxed on it later. So assuming you retire and you're making less money, then you get taxed at a lower rate. You still got to pay tax on it. There's also tax-free savings account where you can put in, I think it's about $7,000 a year to a total of I think in 2025 total will be $102,000. You can put that money into an account, invest the hell out of it, and everything is shielded from tax. So there are some options there that you can do personally. That's a little bit from Canada. Other places will have other laws. If you're in Europe, Australia, New Zealand, other places like that, check out what your country has available. Talk to a professional who can tell you exactly how you can do this, if there are ways to do it. All right, what else we got? Last one, I think.
So for my American friends, if you have a high deductible health plan, you should have a health savings account. So this is probably one of the most tax advantageous accounts you can open, because, Mike mentioned there are some accounts in Canada where the money goes in tax-free, but on the way out, it gets taxed. And that's the case for most of the retirement accounts, it's either taxed on the way in or taxed on the way out. So you're getting taxed on one side. With an HSA, it's tax-free in, tax-free out, growing tax-free the entire time.
America.
So yeah, it is one of the best accounts, and one of the ones that, it's the first thing I max out every single year. And if you're married, you can put a little over $8,000 in it. If you're in the 24% tax bracket, you're going to save $2,000 in taxes. And unlike your retirement accounts, if you have a legitimate medical expense, you can withdraw money from that at any time tax-free and use it. So most Americans, especially if you got kids, you're going to have a medical expense, and this is a tax advantageous way to pay for some of that stuff.
Now, is that available in every state? That's like a federal thing? Really?
Yeah, but it depends on what, it depends on your health plan. So you need to have a high a high deductible health plan, but
Mhm.
just look on your insurance. It'll say whether it's HSA eligible or not.
Okay, that's interesting. I don't know if there's anything available up here in Canada like that or in other countries. Do check that out. If there's some way that's clever that you can do that, that'd be great. And if not, if you're in the US, that's something to definitely look into. John, if you had to pick one of these things to tell a gym owner right now, which would be your top one?
I think the planning piece,
Mhm.
like all the strategy stuff, let's say you do all of it, you're maybe saving yourself $20,000 of pain in taxes. But it's a lot more painful to run a business and not know your actual numbers. So having clean books and having everything allocated correctly is the best thing to do to yourself. And ultimately, in the long run, that'll make you a lot more money than implementing any of these strategies with shitty books.
Yeah. Annual plan for your business should include tax, accounting, all that stuff. And then, like I said, at the tinker level, which is our top, 10% of gym owners, these people are doing incredible things. They're planning lifetimes. They're planning like 3 years, 5 years in advance, and they're planning legacies for their children. And there are big, large strategies they're pursuing, whether it's real estate or investments, all sorts of stuff. And we do have that model in our mentorship program where when you get to a certain level of income and your business is running well, we talk about the Tinker program where you start thinking big. And that's a really cool thing that we've seen people ascend to. You have a bonus strategy. Do you want to talk
I
about
got
that
one
one?
for my tinkers. I got a strategy here for
What
my
have they got?
tinkers.
Yeah, this is cool.
All right. So the Tinker Group, to get in that group, you need to have a net owner benefit over 100,000.
Mm-hmm.
A lot of those people go on to open other locations. And one of the things that I always tell people who ask me about opening multiple locations to consider is buying another gym. And the reason I like buying another gym is because you can easily finance the purchase. It's less risky because if you buy right, it's already making cash flow. And then there's also a huge tax advantage. So let's say you got a gym. Mike, you own a gym. It's doing $75,000 in net owner benefit, but you got $100,000 of equipment. All right. You want to sell the gym to me for $300,000. You with me so far?
Mm-hmm.
Okay, cool. So I can go to the SBA, assuming the business has been around for a while, which is a U.S. government association, and get a loan to buy your gym for as little as 10% down. So meaning to pay you $300,000 to buy your gym, I only have to come up with $30,000 out of pocket. Now, we talked about bonus depreciation, where you can take 80% of, a big equipment purchase and write it off in the first year. When you buy a business, you can do that as well. It's also eligible for bonus depreciation. So you have your $100,000, that's the value of the equipment. I get $80,000 of that as a tax write-off.
Whoa.
So if I have $80,000 in active income and I buy your business, my tax bill then becomes zero. And so on top of that, I get your gym and I get to collect $75,000 in net owner benefit next year, assuming I can operate it just as well as you did.
Mm-hmm. So that's an interesting one. This again comes with a qualifier that John said, don't do stuff you shouldn't do or don't know how to do or don't want to do. But if this is a thing that you're thinking about, that is a benefit that you can take out of it. So this is a strategy that you can use. We at that tinker level, we talk about, John said $100,000 net owner benefit. And I will tell you, net owner benefit is salary, dividends, anything the business pays you, like if it takes care of your cell phone, write-offs, things like that. So that's $100,000. It's stable. It's running without your constant oversight. You have some time and freedom to start saying, what else can I do? Some of our tinkers have gone into like real estate, crypto, Airbnbs, all sorts of really cool stuff. One started a beverage company, one started a whiskey distillery, I believe. You might decide another gym, a second location. Now, there's a little bit of a trick because sometimes people say, I'm going to do this. I'm making $50,000 at one gym. If I open a second gym, I'm going to make $100,000. And it usually doesn't work like that because the second gym takes way more work than you think. And all of a sudden you're only making $30,000 because one gym is dying, your golden goose, your other one is floundering as well, and you're screwed. We've seen that way too often. But if you're in a really good spot, you're working with a mentor who can tell you, hey, you want a second location, your first one's great, let's replicate this over here, or let's buy this thing. That's an interesting strategy that you can use. And that's a really clever one, John. Did you use that one?
Yeah, but the problem with CrossFit specifically is one, there aren't a lot of CrossFit gyms generating more than $75,000 in profit being run with like professional management in place.
Yeah.
So finding a target is difficult. And then the second piece that makes it work a little less effectively in CrossFit versus some other models is it's pretty lean, the equipment in there. The price of a lot of this stuff has come down. There's not a lot of CrossFit gyms where the fair market value of the equipment is $100,000 plus, so you have less of that. You can take less of that bonus depreciation. Whereas if you're going and buying a Planet Fitness or an Anytime Fitness, and you got just lines of treadmills and ellipticals and all kinds of more expensive machines, it creates a lot more of a shelter than say going and buying your local box down the street that has, $5,000 of rogue equipment in it.
Yeah. And you'd probably have to time that in the right life cycle of that equipment depreciation, right? So if some owners depreciate all the equipment and there's really no equipment value, then this is not a valuable strategy.
I think you can get an analysis done to determine what the fair market is. So
yeah, okay. That's interesting because like a lot of we see rusty barbells,
Like, I was talking to my accountant to run the strategy, and she's like, you should buy a trucking company. And I was like, I don't know shit about trucking, so I'm going to pay my taxes, But yeah, you can, it's the fair market.
Yeah. Okay. Well, that's an interesting one to look at if you are thinking about stuff. But again, I'd tell you, talk to a mentor and figure out if buying a business and doing that is right for you. This has been Run a Profitable Gym. This is John Franklin. He is the Chief Marketing Officer for Two Brain Business. He also runs Kilo and a bunch of other stuff that he knows is very interesting. It'll help you out with, he'll be back on the show regularly to talk about all sorts of different stuff, a lot of financial things. If you want that P&L that I showed earlier, Chris Cooper has it. You need to go to the Gym Owners United group. GymOwnersUnited.com will get you there. Go in there and you'll see Cooper everywhere. He has got lots of pinned posts and featured posts. DM him and say, Coop, can you send me your P&L statement? It's created exactly for gym owners. It has many of the lines that you will need in your business and some really cool special stuff that Coop's got in there. You can start dropping numbers in there and it's going to do calculations. And he's talked about that in our blog this week. You can use some of the stuff that he's got to do experiments. What happens if I change this number? What happens if I do this? Does this profit go get bigger if I do this? How can you work that? So Chris has called it a sandbox thing. Save a copy of this thing, start working your numbers, see what you can do. And then if you want to start moving these numbers and you don't know how to do it, work with a mentor. You can book a call in the show notes to do that. John, thanks for being here today and sharing these strategies. I hope this helps people out as they move into 2025.
Hey, tax is my passion. So, I'm glad I got the good assignment.
Yeah, you always get the fun shows, but I think we got some that cranks helps out and helps gym owners. Run a Profitable Gym. Please hit subscribe on the way out the door. Thanks.